We're 90 minutes before the open on Tuesday, January 25th. Hello, traders. Lots of market movement. Great for day traders, not so good for swing traders yet. Looked like we were going to have the formation that I was looking for yesterday. Everything was kind of shaping up as far as the daily chart, but the intraday chart was not what I wanted. I'm looking for that deep sell off, that air pocket, that, oh my God, the market's never going to rally again moment. As soon as you have that type of low, then you start looking for that bullish hammer, you start looking for that bullish engulfing pattern, and then you're looking for stacked long green candles consecutively, at least 5 of them on just massive volume. That's a capitulation low. We did not see that yesterday. So let's take a look at the chart and see what did unfold. So right here, you've got this big gap down. I'm going to talk a little bit about 1OP as well. So if you shorted on the opening, you started to see these tiny red candles stacked. Again, these are not long red candles. I would like to see about 5 or 6 of these somewhere in the course of the decline stacked very close to each other, and then just a giant red candle free falling. Then the next one, another free fall that turns into a bullish hammer. Or perhaps that other prior red candle is just right out of the gate a bullish engulfing pattern. Either one of those two would signal that deep low and that intense interest to get long. And then you start stacking long green candles. We didn't have that. Yesterday, what we had was a very tenuous decline. Yes, we've got a nice gap down. Yes, we have consecutive red candles in here. So that tells you there's some pretty decent selling pressure. But notice how these candles start to get smaller and smaller. That's a sign of support. Oh, here we go. Got a little bullish hammer in here, green candle. That was quickly erased, but look there. We've got a bullish engulfing candle right here. Now that does not mean buy, especially after the heavy selling that we've seen over the last few weeks, especially on a gap down below the 200-day moving average, especially with consecutive long red candles. That tells me in here, this could be just a head fake, just a bounce to shake out some shorts, could be a little bit of profit taking. We have a bullish 1OP cross right in here. So you can see if I'm short, and I see these tiny compressed candles in here, and now I get a mixed candle in there, I should be thinking take profits on your short position. That does not mean buy. Does not mean buy. It means I should probably be looking for a bullish, or excuse me, a bearish flag formation. So there's your rally, there's your upward sloping trend line. Blam! Long red candle that erases this little bounce right in here. Well, that's your sign that we're going to be heading lower. So you get another bearish cross right in here. That's a pretty decent sell signal. And then the market continues to head lower and establish the low. Now you've got some compressed candles, tails under body. That tells you that we're going to get a bounce. You've got your downward sloping trend line that comes in like that. You got a green candle. You got a bullish 1OP cross. Everything here looks good. But let's talk about this formation first. So this is not that air pocket. This is not that heavy selling. This is just a normal market low. So yes, we're going to get a bounce in here. Got this nice 1OP cross. Now you have technical confirmation that yes, the downward sloping trend line has been breached and we're going to get a nice little rally out of this. So I want to talk about this particular moment because there was a trade that I did yesterday, and I'm going to mention why it was not a good trade. So we get this rally in here, and this all looks pretty good. These candles are starting to stack. So that tells me after price action like this, that this low is probably going to hold because otherwise sellers would be so aggressive, you'd never have a chance to stack that many long green candles. But you can see there's overlap. This is almost a doji in here. So this is not straight up. This tells you that there is also resistance, which when we get that liftoff, 1, 2, 3, 4, 5 long green candles stacked consecutively like a rocket, just going. No pauses, no looking back, no nothing. not seeing that type of selling climax, so we're not going to get that type of reversal. But right in here, this looks pretty good. And then you get this long red candle. And this looks like, hey, we're going to retest the lows again. That is a pretty big candle. But then there's no follow through to it. So that tells you, especially after this candle, that, if you were short in here, you better exit that trade because we've got more upside. And sure enough, the market starts to lift off in here. Now up in here is where I actually took a long position on that candle right there. And you can see how we tried to challenge the high of the day. We already had a bullish 1OP cross, so everything was good there. This is where I tried to get long. I was flushed out instantly, and it was about a 25-point loss on the S&P. My thought was one of two things is going to happen. We're either going to reverse lower off of this check on the high, or we're going to break out to the upside. So given a 50-50 scenario, what I really should have done, and I regret not doing, is I should have been paying attention to the 1OP bearish cross back in here, because that signaled to me that this bounce was getting a little tired. And I should have been looking for that short upward sloping trend line in here, breach to the downside. Once I saw that red candle, I took my losses. I did pivot. I shorted. I was able to make my 25 points back here. Now I exited right in here. Well, why did I do that? Well, you can see if you draw an upward sloping trend line, it comes into play right in here. In fact, I can drop that line, and those are always going to be important technical support areas. So I took profits here, made my 25 points back. Here is a bullish 1OP cross. So when I was tempted and when I liked what I saw in here, short dip, rebound, challenging the high. When I saw this strength in here, I should have been waiting. I didn't have to take that short. I could have. It was a nice one. But the better plan would have been, instead of trying to get long here and hoping for a breakout to a new high of the day where we fill in this gap, I should have been more patient because we were already very, very late in the bullish 1OP cycle. Best thing for me to do, just wait. See if we can get through, see if that move has follow through, see if we can get in the gap, and give some of this bearish 1OP cycle a little time to unfold. See what it produces. Normally, it's going to produce a sell-off. About 80% of the time, the market is going to do what 1OP is telling you it's going to do. So in here, when I see that we have a higher low, double bottom, and that support right here was able to hold. So I got higher low, double bottom, support here, horizontal, nice little bullish hammer. I have a bullish 1OP cross. This is where I started to buy. That was a beautiful entry point. Now, let's talk about something else. The reason that I bought here, and I was a bit too aggressive, is because I was looking at the daily chart. And the daily chart left me with this gorgeous looking bullish hammer. And after this type of stacking, I thought, there's a good chance that this market could go. Look at that bullish hammer. I'm not going to put up the major moving averages because it'll get in the way of my 5-minute chart. Look at that bullish hammer. That has buyers excited. I believe that the downside, yes, we're down 60 S&P points overnight, so we're going to give back some of these gains. We're going to probably be down on that support level again today. I don't know that we'll test yesterday's low. Giving the type of buying that we saw here, I do not believe we're going to test this low, but I do believe that these are all nervous jitters ahead of the FOMC. Now, one thing that we're seeing right now, I'm not going to get too involved in this, but we're seeing a backwardation in option implied volatility. That tells you that institutions are preparing for the worst tomorrow. They're jacking up all the very, very short-term weekly option implied volatilities, but they don't see that type of uncertainty lasting into the future. That's why we get something called backwardation. That is actually a bullish sign for the market longer term. It doesn't mean we're going to rally today or tomorrow, but it does tell me that a bottoming process should start forming here soon. So let's continue with this analysis. As I mentioned, this was the point to really get long and to get aggressive. I'm thinking, gosh, that bullish hammer is forming. If we come up to the high here and we take it out, this will go. And it did. So I ended up making 40 points on a long position that I had yesterday. And by the close, I had one more leg of that position on. It was up 60 points. Unfortunately, I'm going to be giving that back on the open today. I was looking for follow through. I was wrong. I'm still in the position. I'm going to hang on to the position. I'm going to see what happens. I believe we're going to retrace right to about this level today. You can see a little bit of a inverted head and shoulders formation, breakout here through the neckline, off to the races, big volume, great 1OP cross. So the takeaway today, this is Tuesday, this is the day before the FOMC statement. Here's what I'm looking at. I love this strength in here. Love it. This tells me that buyers are still engaged and that they're getting more and more aggressive here. We're going to get a big 60-point drop on the S&P this morning. What I'm going to be looking for is for this support to hold. I'm going to be waiting because now we're going to open the day on a spike in 1OP. So naturally, it's going to roll over. It's going to pull back because we've got market selling. I'm going to let that 1OP indicator drop, 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 get a nice deep trough, and then I'll be looking for a bullish cross, something like that. Hopefully, when this all transpires in the first half an hour or so, this support is going to hold. So let me repeat that. Got a big drop in the market. Want to see that 1OP indicator fall down. Want to get that bullish cross, and I want to see that level hold, which is approximately, let's call it 434 on the SPY. If that happens, I'm going to be looking for that bullish cross, and I want to start making progress again early in the day. After yesterday's price action, I am much more in the camp of there's going to be a buying opportunity today than I am in the camp of, oh my gosh, we're going to test this low and everything's going to fall apart today. I'm not going to guess. I'm going to watch. I'm going to wait. I'm going to be patient. That's the pattern I'm looking for. Send this thing down, send that 1OP down, hold that support level, get a nice bullish cross, look for those long green candles stacked. That will be a nice entry point. Why am I so dang bullish anyway? Well, I'm really not. I'm actually more neutral. I'm going to go into the daily chart, talk a little bit about the price action. Interest rates are still near historic lows. Everybody's in panic mode right now. I think part of that is because they've been relatively unhedged, and we know that because option implied volatilities have been super, super low. That means institutions are not buying protective puts. That keeps the option implied volatilities low. When you get the biggest drops, no one's really looking for it. So it stands to reason you got this breakdown here. Now everybody is scrambling to buy protection. And I'll just put up UVXY. You can see how short-term option implied volatilities have spiked. They backed off yesterday on that rally. Until then, they were tiny. Tiny, tiny, tiny option implied volatilities. So no one was expecting anything bad to happen. That's when you get your biggest market drops. Also up in here, we had lots of bullish speculation. Well, those weak hands are getting flushed out immediately. And we saw the warning signs up here. Please go back and watch my videos 2-3 weeks ago. I was already referencing how this light volume rally and these compressions on an all-time high were a sign that we were going to get some selling. And I referenced that long red candle and said, once we see a long red candle off the high, we get follow-through selling. You can go back in the chart. You can look at all those moments. Look for that high. Look for that red candle. Then you'll see the follow-through. Follow-through. So anyway, the S&P 500, we've got this nice bullish hammer. We're going to be coming back. We're going to be testing support one more time. If buyers see that support, then they're going to be more aggressive. We've got earnings season coming up. I think the mega cap tech companies are going to report good numbers. That should lend some support to the market. we get the FOMC statement. The Fed sees what's going on. They're not going to come in and destroy the market and create all sorts of fear and panic. They want to instill calm to the market. Yes, folks, we're going to have to raise rates. We're going to have to do a little bit earlier than we'd like to, but we're going to be as accommodative as we possibly can because, and then fill in the blank. We don't see the job growth that we wanted. Coronavirus is still a concern. Supply disruptions, whatever their flavoring is going to be, they're going to tell everyone, listen, yeah, we're going to hike, but then the next one is going to be off in the distance. Everybody will breathe a deep sigh of relief, and then the market should be able to recoup itself, probably get back to the 200-day moving average with ease. And you can see yesterday we got right within striking distance. I think we're going to be above the 200-day and spend some time between the 200-day and the 100-day moving average. This type of market movement, though, I mean, this is very unnerving for swing trading because you get these gigantic moves and you just don't know how to position yourself overnight. I took a swing position overnight and I'm regretting it. I just let 60 S&P points slip through my fingers. So I'm not real happy about that. I had to go with the pattern that I saw, and the pattern told me on a bullish hammer and a close into that previous red candle that we were going to be running up. I expected to turn on my screen this morning and to see us testing the 200-day moving average. And then I thought we would simply spend some time right at that 200-day moving average going into the FOMC. Didn't play out. So overnight swing trades, kind of dangerous, but we may get that second confirmation of technical support. And then when we get that rally, get up to that 200-day moving average, I think we'll be in pretty decent shape to swing trade for a bit from the long side. So be cautious today. Watch what's playing out. My pattern, deep sell-off, big drop, 10p, bullish cross. This support level at 434 preserved. Next bullish cross, we start stacking some green candles. That will tell me that these buyers are still around and that they are able to overpower the selling pressure. So that's what I'm looking for. If I don't get that and I get this big, deep drop in the 10p and we start stacking long red candles, then I know that that pattern that I was looking for yesterday might actually happen today. Long red candles, 4 or 5 of them, just this gut-wrenching free fall. Then on that last long red candle off of a new low of the day, you get that big bullish engulfing candle, and then about 5 or 6 really long green candles after it. That's a really good pattern to trade on the long side too. I'm going to tell you something else that you should be doing right now. If you are a swing trader, you're nervous. I don't know. Should I be buying now? Should I be on the sidelines? If you've got that kind of mentality right now, you need to stay sidelined. You have no staying power because you're nervous. And you should be on the sideline. I'm not saying you should come in and buy right now. Don't do that. There's a better way. Here's a better way. Let's go in. I'm just going to take a look at the big companies. Let's say Apple is one that you really like. So what do? You click GTC, click that candle right there. Whoops, I clicked the wrong one. So in any event, you'd want to drop your downward sloping trend lines. Let's try that one more time and see if I can get it right. So you click that candle, connect it to that candle, you got your downward sloping trend line. When that's broken to the upside, hey, I should have a nice buying opportunity. Microsoft, that one was a little bit steep on Apple. There's my downward sloping trend line on Microsoft. Nice long bullish candle, earnings coming up. And those earnings are coming up after the close. So you should start to see some support in Microsoft into the number TSLA. Just do it for all of them. Look, I've got my downward sloping trend lines drawn. They may not trigger for a week or two, but when they do, I'll know it's time to swing trade this from the long side. Amazon, same thing. Google, Go through all your lists right now. If you have stocks that you like long term, start clicking on those candles and dropping those alert lines. Then what happens is the market recovers, it starts moving higher. All of a sudden, bing, 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 you start getting all of these alerts coming up. You don't have to go looking for the trades, they're delivered to you on a silver platter. And that's when you know that critical price points that you've identified previously have been breached. You can also come in and say, hey, this is a nice horizontal support level right in here. If Amazon can get above that, I'd like to know. Click GTC, double click on the top of that candle. Now I have an alert line there. You can do the same thing on a shorter term chart. If you're a swing trader, you can identify those support and resistance levels that you want to key off of. This one right here, hey, if Amazon can get above that resistance line, it's also above that resistance line, I'm interested right here. Get the alert. I don't have to take a position. If the market's falling apart, but the stock gets through that alert line, I don't have to do the trade. I can simply drop another alert line anywhere else that I'd like. As far as selling out of the money bullish put spreads, you got to be careful now, but this is the type of stock that I'd be looking for. Let's just bring up SFM because I had noticed it, and I looked at the option implied volatility. As you can see, stock, orange line above zero, has relative strength. Really nice. Given the market meltdown, this stock has held up pretty well. Any of your basic material stocks, any of your food stocks, your consumer staple stocks are going to do pretty well right now. And the reason for that is that inflation is a primary concern. Inflation is one of the reasons that the Fed is needing to raise interest rates. Well, these companies have pricing power. If you are a basic materials producer, you can raise price. So they're going to be able to preserve their profit margins as a result. And same thing with this company, which is it's Sprouts Farms, so it's a food reseller. Should be nice, consistent earnings. Raise your prices as needed. You can do that quickly. So these companies have actually found support, and no matter what the economic conditions are, people are still going to need to eat. So you can see that that 50-day moving average comes into play at about $28. I did take a look, and there's an option expiration that only has monthly options. So February 24th is the earnings announcement date. When you're selling out of the money bullish put spreads, you always want to make sure that your bullish put spread expires before the earnings date. In this case, it does. So the February 18th options expiration is before that earnings date, and you want to give yourself lots of protection. So you want to be below that 50-day moving average. You'd like to be below was technical resistance. Now it's support. Comes into play around $27. You get a little drop in the stock this morning on a 60-point S&P 500 sell-off, and you can sell the 27.25 bullish put spread for 40 cents. I think that's a pretty good trade on the notion that the market is going to find support over the course of the next week or so, on the notion that a food company like this is going to be popular with asset managers. They're looking to park money in safer stocks right now, so you should start to see a rotation into it. So take advantage of that. I think that's a nice little bullish put spread that I would be considering. Again, selling the 27, buying the 25 put for a credit of 40 cents. That spread expires, everything plays out according to plan. Stock continues to march higher, spread expires. That's a 25% return on that bullish put spread. That's all I've got for you today. Really wanted to focus on price action, what you should be looking for, overlapping candles, how to tell when a move is starting to find support. So one more thing on this low right here, we get a nice little bounce. This bounce lasted about 40 minutes or so. If you get heavy, heavy selling, you want to see maybe a 15-minute bounce. So you come down, get one or two candles, and then right back down again. That tells you that there's extreme selling pressure. So once you see this last for about 40 minutes, you know that there is support forming. So now you get your next leg lower, and all of a sudden, already, here's a bullish engulfing candle. Well, we barely took out that low. So this is what I call a marginal new low. Okay, here we go. Up, up, up. Oh, look, we're going to go down again. Tiny little candles, nothing big, and another marginal new low. You start stacking candles right in here. You're compressing. You got tails under body. You've got a bullish 1OP cross. Hey, you know what? I think we found support now. So that's the type of technical analysis. It's the way that you need to be reading price action to get a feel for what the market is telling you. Where are the buyers? Where are the sellers? Now you get your lift off and you can start joining that move once you have technical confirmation. Good luck with your trading. Going to be some volatility for the next day, maybe day and a half, but at some point we're just going to rest. Market's just going to sit there. Everybody will have squared up their positions, and then we will be dead till the Fed. So look for some choppy trading over the course of the next day and a half, and then we're just going to sit and wait for the Fed. Good luck with your trading. We'll see you tomorrow. Thank you for watching this YouTube video. I'm Pete Stolzers, and I'm going to keep the trade ideas coming along with lots of education. So make sure to subscribe to the channel and please turn on your notifications so that you never miss another trade. If you like the content, please give it a thumbs up. I've loaded 2 other videos that I think you're really going to enjoy. Stay tuned. We'll see you soon.